All right, gentlemen, thank you for joining us this month for the Fireside chat.
Go, Robert.
Hey, Rob.
Chris, might just start off talking about bond markets. Scott Bessent says he's not interested in anything other than the bond market. Well, the bond markets around the world are talking. What's going on?
They are talking, Rob. So, look, for the better part of the last couple of years, bond market's been oscillating between a recession sort of picture and then a stagflation type picture. And so whenever there's fears about something, tariffs released or some other event, they start to price in recession and yields fall away pretty aggressively. And they quickly realize that inflation's not going anywhere. And then they start to change course pretty aggressively. And so you have this constant oscillation. Reference here is probably the US 10-year bond yield is the best reference point. And so you had lows of 3.6, 3.7. You've had highs closer to 5. And more recently, range bound between sort of 4.2 and 4.5 sort of been the range, which again, we've become quite accustomed in the near term for that range being a fairly sensible range. But on a 10-year bond yield, that's actually fairly significant moves in capital value because you've got 10 years worth of duration or movements. But more recently, obviously, a lot of the talk around town has been specifically in relation to the US and Japan. With regard to the US, it's really been about the fact that you've got a huge budget deficit still operating in the US, with a bill recently passed to add more to the debts.
The beautiful bill.
Beautiful bill, that has been referred to. And that has come sans savings. So there was the way the path was supposed to work from here was there was supposed to be significant cost savings found to make the bill a little bit more amenable on the debt load. And those debt savings or those savings more broadly haven't been found just yet, whilst the bill has secured passage of the lower house in the US. And so bond markets are pushing back pretty aggressively against that, given the increase in supply of bonds required to be able to pay for that sort of bill.
So just to put it in perspective, the US has got about $37 trillion worth of debt, and that doesn't count unfunded liabilities. The deficit, I think it's probably going to be around about $2 trillion again. And the US government brings in regards from receipts from tax and what have you, about $5.2 trillion. But most of that goes on defense. It's over $1 trillion. Interest, well over $1 trillion. Be getting up around 1.3, 1.4, I'd say now, trillion. You've got Social Security, Veterans Affairs, Medicare, all these other things in there. They pretty much take it to $5 trillion anyway. So there's not a hell of a lot of give there, and I think that's what the bond market's telling us, and I think that's what the gold market's also telling us.
True, very true.
How are they going to get out of it? They're going to print money.
That's it. So yeah. So look, there's levers that they've got at their disposal. The question is, when they use those levers, how do they use them, and when do they use them, and what are the impacts for markets? Markets obviously push back, whether it's the equity market pushing back or the bond market pushing back, or currency markets pushing back as well, as we've seen of late. So it's a difficult game to be playing. And I mean, look, with any person that's got debt or carrying debt, you don't want to see higher yields. The US government's heavily in debt, so refinancing at 5% or higher is catastrophic for them, and it needs to be significantly lower. Scott Bessent, the Treasury Secretary, has made that pretty clear through the course of his term or at the start of his term, where he's made it very clear that he wants to be raising debt with a 3 handle, and they're a long way from that at 450. So
he wants to borrow money, so he wants investors to lend money to the US government who's got a debt problem and a deficit problem, and they're going to print money. He wants people to lend him money for 10 years at 3%.
That's correct.
Yeah, good luck with that.
That's it.
That's why we don't own long duration government debt.
That's it.
Okay.
So that's the US equation. That's been pretty much the fixture of markets now for a little while. The Japanese bond market more recently has become a problem, and this has been festering for a very long time. We obviously saw some issues with the carry trade in the yen last year. So we saw that blip sort of play out for a few days, maybe a week, and we're sort of getting potentially Mark 2 of that again now with regard to Japanese bond yields. So more recently, you had a Japanese inflation print, which was much higher than expected, which pushes the central bank there to consider raising rates more aggressively. Japan has had rates at 0 and or negative for a long, long time. More recently, they've been incrementally raising rates a couple of times, and needing to raise more, but have been holding back. Inflation has now spoken, and you've got Japanese bond yields rising fairly aggressively. And so some might say, so what? What's the problem with yields being higher? It's attractive to savers, that sort of thing. There's a couple of big issues to note here. One would be the fact that if you're a Japanese saver, you've been starved of interest for a long time. So what you've done to mitigate that is you've parked money offshore. So you don't park your money in Japan, you send money everywhere and elsewhere. So Australian bonds, Australian cash, US bonds, US cash. If you've got homegrown government bond yields now at 2s, 3s, or 4s, you're going to bring the money back. There's no point having it offshore where the currency risk. So there's definitely a risk of that money coming back. So that's a risk to other markets, not necessarily the Japanese market.
And with that strength in the interest rate, the currency weakens.
That's it.
Sorry, the Japanese currency will strengthen, which basically means that the assets you've got offshore are losing value because of currency movements.
That's it. So so it has implications for currency. It has implications for foreign flows. It has the implications for assets in those markets. So there's a wide-reaching ramifications for that. The other thing would be that, Japanese government is the most heavily indebted in the world, as we all know. And so just as I made the comment now about the US Treasury Secretary wanting to raise debt at 3, the last thing the Japanese government wants to do is roll over debt with a 2, 3, or 4 handle on it, because it'll bankrupt them. Now, I don't think we've mentioned before, possibly not, but most of Japanese debt is held by the central bank in Japan. It's a rather odd predicament and odd environment to be in. So it is potentially a closed loop system from that perspective. But again, it's still a problem for them, and it has wide-ranging ramifications for global bond markets and equity markets. So, so two big debtors in markets, so the US government and the Japanese government, having to deal with years of profligate spending and not enough tax revenue, potentially in the Japanese case, given the aging population. And at some point, that debt comes home to roost.
Yep. No, absolutely. No, it's interesting times. Clint, I thought we might have a bit of a chat today about defensive assets. In particular, I thought we'd talk about, say, cash, term deposits, liquid sorts of investments and why you might keep them. And then other type of fixed interest investments, particularly things like mortgage funds. What's the difference? When should you own, or when should you look to own sort of either or in a portfolio sense?
I guess my view, Rob, when you're looking at risk reward, the only risk-free assets are cash and term deposits. Everything else is going to have some element of risk, including bonds. You're going to have cash movements, as we just discussed, with interest rate movements.
Can I just qualify that? That's cash or term deposits below the government guarantee?
Below the $250,000 amount, correct. Then we move on to mortgage funds. Obviously, we've got a number of mortgage funds on the APL that we're very comfortable with. However, these are not a substitute for cash, and I think that's written in the SOA that this is not a substitute for cash. The issue here dates back for those of us that are older. Have a look at something like Challenger Howard Wholesale Mortgage Fund, which is one of the bigger guys back in 2006, 2007 pre-GFC or LM. These are mortgage funds, same as the ones that are out there now. Challenger Howard froze up in, I think it was 2009, and people did not get their money back until about 2018 for the full amount. So 9 years for something that at the time was liquid. Obviously, these mortgage funds manage their assets in a number of different ways for the liquidity mechanisms. They might hold a certain amount of cash, or they might tell you that, right, we're short-term lending, we'll have mortgages constantly rolling every 12 months. Therefore, we're going to be able to pay this out on a monthly basis. The issue there, however, is what happens when markets do freeze up. The borrowers cannot refinance, and the lender, the mortgage lender, is unable to get the money back. And your client, when they need the money, is unable to withdraw
Yes.
for that
So
money.
and that's a great point because, the PDS will say, oh, we offer 30-day redemptions and all this sort of stuff, which is fine while ever the sun's shining, right? However, the sun doesn't always shine. What actually happens, Clint, when a mortgage fund goes under stress?
Well, they freeze it up.
Yeah, and why do they freeze that up?
Well, they can't. Well, exactly what I was just saying. The borrowers are unable to refinance the debt elsewhere. So, if they can't pay back X, Y, Z mortgage fund, mortgage fund isn't going to have the cash to pay out to borrowers. And it's the same as we've seen in property funds. They also rely on new flows of money coming in. That new flow of money ceases. The borrowers are unable to refinance elsewhere, and hence that 30-day redemption facility that they offer in the PDS. If you look below it, it'll say something along the lines of, in the normal course of business, we will offer a 30-day redemption facility. When everything freezes up, it's obviously not normal course of business, and that fund will not be able to pay back that money that the client may expect to be liquid at all times. So anything going into, whether it's a bond fund or a mortgage fund, does need to accept that there is an element of risk and the fact that you may not be able to get the money back when you want, i.e. illiquidity.
So when you're talking to clients, what sort of how are you addressing that with them, and what's the minimum sort of time frame you're sort of saying that you need to be able to sort of be invested for in these sorts of products?
Well, I'll obviously look at what they're up, not as we should in the FNA, what sort of cash and things they need for upcoming one-offs, pensions, things like that, making sure that I'm not putting that at risk of a lock-up at all. And then in regard to the mortgage funds, moving up that risk spectrum a little bit, whether it's bonds or mortgages, explaining that, yes, these can lock up, but I will park a lot of the surplus cash into those. But we're looking at least 12 months plus for that sort of thing. But I do also mention that these things can lock up.
Yeah, you got to have that discussion. Absolutely.
Yeah, but I'm looking for that stuff for at least 12 months plus, and we've seen it with some of our other specific options when it's supposed to be 12 months, and the borrower subsequently does have a issue refinancing, and it might be 15 months or so. That's for some of those specific option mortgages that some of us use. We do need to say it's not definitely going to be 12 months.
Yep. No, absolutely. So, Chris, we spoke about the volatility in bond markets. The equity market's been volatile. So, obviously, there was Liberation Day sell-offs. And ever since a few weeks ago, the market's been rallying back strong again. Is there nothing to worry about?
If you're reading the market tea leaves, then the answer is yes, because it would indicate there's nothing to worry about at all. But look, it's been an interesting ride, Rob, as you mentioned, over the last few months. Obviously, we had plenty of concern during that Liberation Day and week, where markets fell, or some markets fell close to 20% in a very quick period of time, and reverse or sort of roll forward to now, when you've got markets not only making back all those losses again in terms of reaching those levels, but also breaking through February highs. Interesting to watch that play out. In terms of what's played out through that period to make markets think that things are okay. Not that we think they're okay, but to sort of speak for the market, maybe. You've had the reprieve, the original reprieve, the 90-day the delay on the tariffs. You then had a couple of trade deals over the last couple of weeks with regard to the UK and China. And look, they're not trade deals; they're conversations that are meeting with scope to go back and negotiate further. But they've been heralded as trade deals. And then, as recent as the last weekend, you had Trump pushing Europeans to get something done with an increase in tariffs there, and then a reprieve for a month or so. So, look, I think markets are trying to read into the tariff situation as being, if it's not 50 or 60 or 70, anything below that, then that's a positive. Or if they're negotiating, it's at least a positive, because at least trade is then open. I think the biggest concern for market in April was that trade would be shut, not that there'd be penalties for trade. So I think markets are now looking for the openness of trade, and then we'll work through the penalties as they come through. The problem with that is that if you have that degree of optimism, as the market has at the moment, those penalties are lagged. So you think about corporates that are then producing those goods or importing and exporting, they then will suffer delays in a whole range of the issues and obviously drop in earnings, and that'll come through later on. So again, it's odd one for markets to look at. There's also, I mean, the Fed's pretty straight bat at the moment on not cutting rates. So you're not getting the rate relief coming through that might have been expected early in the year. So it's a bit of an odd sort of last 3 or 4 weeks in terms of what markets are listening to and taking notice to. But yeah, so today, I mean, you look at markets today and they look as rich as they looked in February.
So from a valuation perspective, the valuations are quite high, aren't they?
They are. So look, I mean, the odd two primary markets, Aussie market, US market. Aussie market today is 19 times 1 year forward. And US today is 21, almost 22 times 1 year forward. So they're not cheap.
No.
And I mentioned 1 year forward, that implies current estimates on earnings. So, I mean, look, and it's easy. It could be easy to see or very easy to see earnings estimates come down a lot, particularly with regard to the imposts of tariffs and how they work their way through the system. So, very rich market environments indeed.
Yeah. Okay. No, thanks, Chris. Clint, did you have anything you wanted to sort of add, bigger picture wise, regarding markets or what have you?
No, I think you guys have covered it pretty well.
Beautiful. All right. Well, we might go to the Q&A now.